Welcome back to My Finance Teacher. It's very sad that Russia has actually invaded Ukraine. Any war is terrible and sadly costs human lives. I mentioned in one or two of my previous videos that I thought there was perhaps only about a 40% chance of the war taking place and the stock market going to lower lows compared to the low we saw in late January. Instead, my main scenario was a general upward trend for the general stock market, perhaps with a bit of a correction before the FOMC meeting in the middle of March. The main scenario didn't turn out to be correct, so I have to stand corrected here. Looks like the scenario that I was expecting with only about a 40% chance is the one playing out. Now, really interestingly, we see a huge green candle yesterday with the war actually taking place. The markets opened with a big gap down, but recovered all of the losses and, as I said, created this huge green candle. Does it mean that the low is in for the daily cycle as well as for the intermediate cycle in the general stock market starting from early October? Well, I think uncertainty is still there, although as I answered to one of the members at myfinancesteacher.org, perhaps there is a pretty good chance that the general stock market isn't really going to continue all the way down into mid-March until that FOMC meeting. With the markets significantly lower, it's likely that the Fed is not really going to be as hawkish as they have appeared to be so far. Looking at the expectations for the Fed rate hike, for example, we remember that back in early February, the expectation of at least a 50 basis point hike was over 90%. A couple of days ago, it was around 13%, and it's at around 19% now. So there is a pretty high chance that the hike will be of only 25 basis points rather than 50 basis points. So with that in mind, what I think might actually happen to the general stock market is I don't really think that this war uncertainty is going to be resolved all within this one day when the stock market gaps down at the start of the war and just creates a huge green candle continuing higher from here. I think this uncertainty is going to continue for a while. Whether the stock market is going to give us a lower low or not, that remains to be seen. And with this uncertainty on the general stock markets, the Fed might not really reiterate too much of its hawkish stance, which will help the markets to recover, perhaps a bit of a dip just before that FOMC meeting, which again might not really create a lower low with a relatively less hawkish Fed, and a continuation into the new daily cycle as well as the intermediate cycle. So again, there is a pretty good chance that the stock market might actually bottom out next week. But whether it actually bottoms out next week or somewhere around the FOMC meeting in the next couple of weeks doesn't really matter that much in the grand scheme of things, as the time difference between these two options is only about a week. So that would bring us somewhere closer to the average cycle duration, maybe somewhere around 40 days. Although, of course, nobody does know the future, and perhaps we have already seen the cycle low yesterday, giving us a bit of a short cycle lasting for 31 days. With a quick look at gold, if the Fed isn't going to be as hawkish as before, then perhaps a correction in gold into that daily cycle low doesn't have to be severe either. As the war uncertainties continue perhaps over the next few days, again, we're going to see some volatility in gold at relatively higher prices than I mentioned last time, when I was only giving 40% to the chance of the war taking place. And perhaps a bit of a correction down into support zone over here around 1880 of the previous intermediate cycle high. That correction is likely in expectation of the FOMC meeting in mid-March. And after that, the continuation of the rally into the new daily cycle and a continuation of this intermediate cycle. The longer-term view on gold is quite positive. We are breaking out of this relatively long handle formation on the very huge 10-year cup and handle formation. So as I mentioned in one of my recent videos, the longer-term technical target on gold would be based on the depth of this handle, which is around $1,000 or so. So $1,000 added to the breakout area of, let's say, somewhere around $1,900. brings us close enough to the round number of $3,000 gold. That's perhaps over the next couple of years. And previously I have been talking about the $3,000 gold targets based on the behavior of the Fed, based on the CPI and money supply. And the links to those longer-term gold outlooks are down in the description below. Now just a quick look on crude oil. I think crude oil is pretty close to the midpoint of its intermediate cycle. There's a really good chance that crude oil has topped over here around $98.50 yesterday. So over the next couple of months, I would expect some sort of a correction in crude oil, perhaps not down to 68 as some of these squiggly lines indicate, but at least maybe a retest of the previous intermediate cycle highs, somewhere around the $83. But despite this correction over the next couple of months, over the longer term, again, I am bullish on crude oil, and having reduced my XLE positions recently, I'm still holding some. I'll be looking forward to get back into larger XLE positions at slightly more attractive prices. And as I mentioned in a couple of my recent gold-related videos, silver is really attractive to me. At the beginning of rallies in precious metals, often silver lags gold at the beginning of the rally, but later catches up and outperforms gold. So most of my precious metals related positions are actually in silver rather than gold. So in the longer term, as gold goes up to $3,000 over the next couple of years, silver can easily go back to its previous highs around $50 and even beyond that. Think about it. If the gold-silver ratio, here's the gold-silver ratio, continues to drop, it's already dropped from 80 in 2016 down to the current 45. So if this gold-silver ratio continues to drop as silver outperforms gold in the bull market, say if this ratio drops somewhere down to, say, a round number close to 30, with a gold price at $3,000, a gold-silver ratio of 30 implies a silver price of $100. I've recently published a silver report talking about all those industrial uses for silver, and with silver shortages coming up over the next couple of years, a $100 silver isn't actually out of the question. But that's of course what I think. Nobody actually knows the future, so let me know, what do you think? Are we going to see $100 silver, say, in the next couple of years? Before you start with your comments though, remember to hit that like button and subscribe to the channel. Have a nice weekend. Bye bye.